My name is Jason Malabute. I am the founder of Malabute and Company CPAs. So today we are going to be talking about the One Big Beautiful Bill, which was passed on July 4th, 2025. And this is going to be a lot of great tax advantages for real estate investors, real estate professionals, and business owners and entrepreneurs. So I'm excited to share this with you guys. So let's go on to the next slide. So who is Jason Malabute? I am a real estate investor myself. I started investing in single family back in 2018. I've also done multifamily. I've invested out of state. I've been a real estate investor investing in Indianapolis, Indiana, and also Atlanta, Georgia. I've been doing tax and accounting since 2013. I've been a CPA since 2015. All right, so let's get on to the first topic, tax rate. So one big beautiful bill did is it made the tax rates from the Tax Cuts and Jobs Act permanent. So meaning that the lowest tax rate is 10% and the highest tax rate is 37%. Another thing I did is it made the standard deductions from the Tax Cuts and Jobs Act permanent as well. So prior to the One Big Beautiful Bill Act, single filers were getting 15,000 for the standard deduction. Now they're going to get 15,750. Married filing joint is getting 30,000. That increases to 31,500, and married filing separate basically gets half of that. There's really not much advantages of married filing separate, but that's a topic for another day. All right, so personal exemptions. So personal exemptions are permanently repealed. However, seniors who are over the age of 65 years old will get to enjoy an additional $6,000 of additional exemption. However, that $6,000 is phased out by 6% for AGI over $75,000. So what does that mean? Let's say you make $175,000. That means that 175 minus 75 equals 100,000 times 6% equals $6,000. So that means that your entire $6,000 of exemption is gone once you make $165,000, even if you meet the age requirements. So once again, this is only for 2025 to 2028. This is very important for a lot of our clients. We have clients who are 65 years old and they're still investing in real estate, they're active in real estate. So that's something that we want to keep track of is their AGI. And you will see in upcoming slides why the AGI is very important to keep track of, because a lot of phase out and thresholds is determined by your AGI. So AGI management is very important from a tax planning perspective. Okay, next, this slide here talks more about what we just discussed prior. We can skip this one. All right, another big thing is a lot of our real estate clients have children. So the child tax credit has increased to $2,200 and 1,400 of which is refundable. And this credit is going to be inflation adjusted starting in 2026. Okay, as you guys know, one of the biggest headlines about this tax bill was a no tax on tips. And to be honest with you, most of our clients who are real estate investors don't really qualify for this, but this mostly qualifies more for their children who are working part-time jobs. So what qualifies here? Voluntary cash tips, okay? And that this applies for years 2025 to 2028. And this is up to $25,000 of deduction is available. And I want to be clear about this. There's a lot of misinformation about this. This does not affect AGI, but rather this affects your taxable income. Okay. So if you are a Schedule C taxpayer, unfortunately, if you are an SSTB, which is a specialized service trader business, you would not qualify under this. And also, you cannot negotiate the tips, and also those tips cannot be non-voluntary. So, for example, sometimes I go out with clients to go grab dinner, and some places in Los Angeles makes it mandatory for you to pay a tip. Well, that does not count here. Okay, and then also this deduction is phased out by $100 for every $1,000 of AGI over 150,000 single, 300,000 married filing joint. All right, another one that was big in the headlines was a no tax on overtime. So again, this is for 2025 to 2028. Again, this is for this deduction is for the amount of 12,500 for single filers and 25,000 for married filing joint, and this is reduced or phased out by $100 for every $1,000 over AGI. Okay. All right. Here is a big one. I've been seeing a lot of miscommunication and misinformation about this, especially online. I've been seeing people saying that the KBI has increased to 23%, and that is not correct. That did not make it to the final version of the bill. KBI is not permanent, but it's 20%. Okay, so and then starting in 2026, the phase out for the KBI goes from 50,000 to 75,000, 150,000 for married filing joint. And something that's interesting that they have written in law starting in 2026 is that the minimum KBI deduction now is $400, and that's for businesses that have at least $1,000 of KBI. So, meaning as long as you have $1,000 of KBI, you will get a minimum of $400 of our KBI deduction. All right, here's something that's very big for our clients is the new estate and gift exclusion. So prior to this new law passing, the estate and tax exclusion was at $13 million, and it was scheduled to decrease to $6 million. Why is that important? Because your estate includes all your assets. So that means real estate, stocks, cash, bitcoins. And if your assets goes beyond or above that exclusion amount, that is then now subject to estate tax of 40%. So now with the new tax law, increasing it to $15 million now. Well, at least a lot of our clients will be protected from that. So again, estate planning very, very important for our high net worth individuals. All right. Okay, mortgage interest deduction is now limited to $750,000. All right, so what does that mean exactly? So that means that you can only deduct $750,000 of your qualified home debt. So what does that mean in reality? So let's say you have let's say you have 20,000 of mortgage interest, and let's say your property is worth $1 million, right? So since you can only deduct $750,000 worth of the interest, you would divide 750,000 by a million, which would be 75%. Then you would multiply that by the 20,000 of mortgage interest. So then you would only be allowed to deduct 75% of that. Okay. There are some disqualified you should be aware of. You cannot use this mortgage loans for any personal expenses. For example, paying off your personal bills, because then you will not be able to deduct that interest amount. Okay, personal casualty. This unfortunately affects people who are in disaster areas. So now this new law says that you cannot deduct casualty losses unless it is a presidential declared disaster area. But starting in 2026, now state governors will also be allowed to declare disaster area disaster areas that qualify for this deduction. Okay, so for example, here in California, unfortunately, we have a lot of fires. So this is going to affect people who are affected by future fires. I know that in Texas, there was a big flood recently. So this is going to be affecting folks in disaster zones in the future. Okay. So miscellaneous itemized deductions are permanently not allowed anymore. So this includes investment management fees and also tax preparation fees. This is more on the individual side. Obviously, for your business, you could still deduct your professional fees that you pay to your accountant and to your CPA. Okay, but what's new? There's a new above the line deduction is now allowed for educate educator expenses. All right, moving expenses. The bill makes that the suspension of moving expenses permanent. I still remember when I first started in accounting and tax back in 2013, moving expenses was a qualified deduction on your tax return, but not anymore. Okay, here's a big one for real estate investors: SALT. So previously, before this bill was passed, if you were living in states like California where you're paying a lot in property tax, well, previously, you could only deduct up to $10,000 of your state taxes and your property taxes, but now that has increased to $40,000 starting in 2025. But again, there are limitations and phase outs to this, and then starting in 2029, this could revert back to the $10,000 cap, not unless they extend this bill before it sunsets in 2029. So this is big for real estate investors. There's a lot of tax planning that we could do in regards to really maximizing the SALT deduction cap. All right. Okay. Here's another one that was popular. So you can now deduct $10,000 of your car loan to, for your taxes. However, there are some catches here. The loan has to be after December 31st, 2024. The vehicle has to be assembled here in America. Um, and also it cannot be commercial vehicles. So this is big for my realtor clients who are always driving around the city looking at properties, and I'm meeting with clients. So this is big. Make sure that you are talking to your accountant about this. All right, Trump account. This does not come to effect until 2026. So we're still expecting to get more uh, um rules and also information on this. But here's what we have so far. So annual contribution is $5,000 for kids under the age of 18 years old. The federal government will give you seed money of $1,000. This has to be opened before the child turns 8 years old. And then you cannot withdraw it until you turn 31 years old, or there's a 10% penalty. And some things that you could use this money for is you could use it to help you purchase your first property. You could use it to open up your first business. So those are some really neat things that you could do with a Trump account. So this is very similar to a IRA and also a 529 plan. Uh, so here's some more things about the Trump account. So once again, if you withdraw this before you turn 30 years old, there is a 10% penalty here. Okay, bonus depreciation. Here's something that all of our real estate clients were excited about. So 100% bonus depreciation is back, and no, you cannot retroactively apply it to previous years. This only applies to assets that were purchased after January 19, 2025. And why is that an important date? Because that was inauguration date. So meaning if you purchase a property before January 20th, 2025, and if it was put into service prior to January 20th, 2025, then you would not qualify for the 100% bonus depreciation. And something that something that is not spoken about frequently is that for tax planning purposes you can actually opt to to use a 40% bonus depreciation if that's going to benefit you for tax planning. So again, what is bonus depreciation? This mostly is for assets that are 20 years or less when it comes to their useful life. And some of those items are things like lighting, and also things like your bathroom sinks. Those are all things that have a full life of less than 20 years. So that's when you could use a bonus depreciation. And this is big because prior to the law being passed, this was going to be phased out starting in 2027. Because for example, I remember we bought a property in 2023 and we did a cost segregation back then, but we were limited to only using 80% of the bonus depreciation. But now, yeah, but but now we're back to 100% of our bonus depreciation. All right, so 179. Section 179 has been increased to $2.5 million. Is a new expense limit, and it can be phased out at $4 million. This applies to tax years starting after 2024. And this 179 normally applies to assets that have a useful life that is more than 20 years. So as you can see, this is a common question that we get is what is the difference between Section 179 and bonus depreciation? When should we use a Section 179 and when should we use a bonus depreciation? So we have this chart here that really does a good job of illustrating the differences between a Section 179 and a bonus depreciation. So, for example, let's start from the top, right? Section 179, it cannot create or increase a loss. However, a bonus depreciation can create or increase a loss. Section 179 has a cap, but a bonus depreciation does not have a cap, right? What do I mean by that? Remember that the Section 179 has a $2.5 million cap, but the bonus depreciation does not. And the property tax is again, Section 179 is mostly items that have a useful life of more than 20 years. So think about your HVACs, think about your roofs, and the bonus depreciation is normally items that have a useful life that's less than 20 years. So think about your improvements, right? Think about your capital improvements. And also um you can choose asset by asset what items you want to do a Section 179 for. But bonus depreciation, you don't get that flexibility. This applies automatically until unless you want to opt out of the bonus depreciation overall. And also, for a Section 179, you could use it on both new and used assets, and same thing with the bonus depreciation. I always find that difference. It's very interesting. All right, let's go on to our next page. Oops, I'm going too fast here. Okay, so as mentioned here, right, a roof replacement would be a Section 179 because as mentioned before, it's more than 20 years. So, um, because normally a commercial roof has a life of 39 years. So that's how we got that. Okay, business meals. Real estate investors, realtors, we're always out and about having meals with our clients and our teams. So this is very important for us to know. Under the current law, expenses of an employer associated with providing employee meals are limited to 50% deduction. So meaning if you spend $100, you can deduct $50 of that meal. Well, after 2025, unfortunately, that deduction is going to be gone. All right, so here is one of the biggest advantages and benefits that is available in the tax bill. So there is a big push right now for us to increase our production here in America so that we're not so dependent on other countries for production and goods. So one of the biggest advantages in the tax bill is that you are going to be allowed to deduct 100% of a manufacturing property basis on for tax purposes. And yes, you read that right. It's 100%. you are going to be allowed to do that entire amount for manufacturing properties. However, there's a lot of rules that we need to be mindful of. So this property has to be located in America, okay? You need to operate the property yourself. So meaning you cannot be a landlord leasing out the property to a manufacturer. No, you have to be the actual manufacturer yourself. You need to own that property and you need to be producing a widget here in America. And construction needs to start after there's a date again, January 19, 2025, which is inauguration date, and the construction has to be done before January 1st, 2031, and must be placed into service before January 1st, 2029. Okay, so this is huge tax advantages for people who take advantage of this. Okay, opportunity zones. Opportunity zones is back because, as you guys know, opportunity zones were supposed to sunset on December 31st of 2026, but now it's back. Okay, so here are the deferral periods. Remember, for the old opportunity zones, if you invested in a opportunity zone before January 1st of 2027, you need to recognize the gain by December 31st, 2026. However, for the new opportunity zones, if you invest between January 1st of 2027 to December 31st of 2023, I mean, 2033, then you recognize the gain in December 31st, 33. And so what's the difference between this opportunity zone and the current opportunity zone? Well, this opportunity zone has more of a focus on rural areas. So here are some of the benefits. So if you hold the property for 5 years and you get a 10% step up basis, then if you hold it for 10 years, then the full capital gains is excluded. Okay, so let's move on. And I saw that we have some questions. I will answer questions at the end of the webinar. Okay, here we go. Here's something about the light tech. So this permanently increases the state housing credit ceiling starting in 2026. So pretty exciting stuff here. Oh, 1099 reporting. So as you know, for all of us real estate investors, and also entrepreneurs, every January we're always scrambling to go and issue out 1099 to our independent contractors. And here is a pop quiz. What is the old rule when it comes to how do you know who you have to issue a 1099 for? Well, the answer to that question previously was $600. So if you paid an independent contractor $600 or more, then you would have to issue them a 1099. However, with this new law, this increases the threshold from $600 to $2,000. So that is great because then hopefully we can cut down on those pesky 1099s that we need to issue out every single January. All right. So this change, very important because I want to be clear here. This change takes effect in 2026. So that means that in January of 2026, for your 1099s for 2025, the threshold is still $600. So technically, we're not really going to see this change until January of 2027 when we are issuing the 1099s for 2026. I hope that makes sense. I hope I did not confuse you guys there. Okay, 1099K. So 1099K, the requirement here is if your total payment exceed $20,000, and if you had 200 transactions or more, you will get a 1099K. So this is important for our entrepreneur business clients who receive a lot of payments via credit card. All right. Exclusion of interest for loans secured by rural or agricultural real estate property. So this bill allows qualified lenders to exclude 25% of the interest income received on loans secured by a rural or agricultural real estate. So that's a big benefit to them. Okay, so this applies to lenders such as banks, insurance companies. It only applies to new loans issued after the law's enforcement. Okay, gain from farmland. So this is interesting. So if you own a qualified farmland and let's say you sell the farmland and you get paid in full in day one, right? In day one, you Andre pays me the full amount of my asking price. I, the seller, can still choose to recognize that gain 25% for each year for the next 4 following years. So that's very important to know if you are looking to sell farmland and you are trying to minimize your taxes, especially your capital gains. Okay, what else do we have here? So we have R&D expenses. So what is it? So there's some new rules about this, right? So this mostly qualifies. I mean, this mostly affects small businesses. What is a small business in this situation? It is businesses who make $25 million or less. Okay, so what does it mean? So foreign R&D must continue to be amortized over 15 years. However, domestic R&D, so that's research and development, you can expense the entire amount as long as it's paid or incurred after December 31st, 2024. So that is a big tax benefit for those who qualify. And what exactly qualifies here? I'll tell you, it's land, building, mineral exploration. Unfortunately, does not qualify. Okay, does not qualify. I want to be clear about that. Um, taxpayers can elect to spread domestic R&D deduction over up to 60 months. So remember what we said. We can either deduct it in full, um, in the current year, or we can spread it out over 60 months. So this is amazing when it comes to tax planning because there's so much flexibility here. All right, let's go on to the next slide. All right, so unfortunately, let me go back to the top. So unfortunately, there are a lot of tax credits that are going to be sunsetting soon. So here is a list of some of the tax credits that's going to be sunsetting. So it's mostly a lot about energy efficient home credits, vehicle um clean fuel credits. All this is going to be sunsetting. So if you want to take advantage of these tax credits, it's important for you to be mindful of these um expiration dates, right? Okay. So here's another one. This is very important for our syndicator clients. So normally under the tax law, it said that if you have 30% or more of your losses going to your limited partners, you are considered a tax shelter. And if you are a tax shelter, you are subject to Section 163. Section 163 is a tax rule that limits how much how much business interest expense you can deduct. So this is crucial for our syndicator clients. So the old rule says that interest deduction is limited by using after depreciation and amortization. But now the new rule says that you don't have to back out amortization and depreciation anymore. So this is great for our syndicator clients because now they can deduct more of their interest expenses for their tax return. So this is great. Okay, let's move on to the next slide here. So I see that we had some people show up a few minutes late. We'll be sending out a replay for anybody who registered and people who are interested. Does anybody have any questions? I believe I saw some questions here. Let's see. Yes, yes, Kara, will definitely be sending out our replays, as soon as we're done. So, thank you again, you guys, for attending. If you guys have any additional questions, you guys can always shoot us a message. We're more than happy to answer any questions that you guys might have. And let's stay connected. Here's all my social media. I'm always active on those. I'm very active on Bigger Pockets. I'm always answering questions in Bigger Pockets. So thank you again, you guys. I really appreciate everybody spending their time with us here tonight. Thank you very much. Talk to you next time.